first and foremost, check your emotions. Hello, I'm Phillip Smith, financial planner with Tidepool Wealth Strategies, dedicated to helping late career professionals navigate the tides of retirement planning with clarity and confidence. This is your retirement planning guide to money management, pursuit of long-term financial growth, and creating an adaptive strategy tailored to your unique and evolving journey. In every episode, I'll share concise, actionable insights to help you plan a retirement of purpose, resilience, and confidence. Welcome to
The Perfect Retirement Plan?
Hi, and welcome to the episode. Today, we're addressing a big question many of you might be asking right now, and which I have heard more than a dozen times in the past few business days. Should I cash out and wait for things to calm down? Let me paint you a quick picture. You've worked hard, saved well, and suddenly, boom, the stock market feels like a roller coaster you did not want to ride. Headlines about tariffs, inflation fears, and global uncertainty are everywhere, and you're wondering if it's time to step off this ride and hold on to the cash that you have left.
Yeah, nothing screams confidence like pulling all your chips off the table mid-game and hoping to guess the perfect time to get back in, huh?
And while it seems safe to sit on the sidelines, today I'm going to walk you through why that decision might do more harm than good, and how a thoughtful, long-term strategy can help you continue to sail forward through these turbulent waters. I've met with clients who said they lost half their retirement in 2009, and a few key questions revealed that they took their money out of the investments late 2008 or early 2009 only to reinvest a couple years later. March 9th of 2009 was the bottom of that decline. I even have a client who wouldn't let me talk them out of going to cash in March of 2020. The only client to end the year with a negative return. Mistakes can be the best teacher. With investing, it can be a very expensive education. Here's what we're covering today. First, we'll talk about why the current volatility feels so intense. Then, we'll look at what history has shown us about cashing out during times of crisis. After that, we'll discuss the real costs of sitting on the sidelines. Spoiler alert, they're bigger than most people think. And finally, I'll share how a thoughtful retirement plan can keep you steady, secure, and moving forward despite the chaos. Let's wade in together. Here's why current market volatility feels scarier than ever. Right now, headlines are making investors dizzy. Markets plunged recently after announcements of new tariffs by the White House, causing a nearly 1,200-point drop in the Dow in just one trading session. On April 7th, the Dow experienced a nausea-inducing whipsaw of over 2,000 points in a single hour. Add concerns about rising inflation, interest rates spiking, and ongoing global tensions. It's no wonder investors feel like they're on shaky ground.
It's like we've turned investing into an extreme sport, and none of us signed up for that.
Some of us knowingly did, though. Here's the reality. Volatility isn't a bug in the stock market. It's a feature. Markets have always had ups and downs. What's different today is our constant, instant access to information, which amplifies the emotional reaction, makes every dip feel like the beginning of the end. So let's talk about history for a moment. It might feel good emotionally to jump to cash when things get scary. But historically, it's proven costly. During the financial crisis of 2008 and 9, many investors pulled out at the worst possible time, right when the market hit bottom. Those who cashed out then missed one of the strongest recoveries ever recorded. Likewise, investors who fled the market during the COVID downturn in 2020 missed out on massive rebounds in just a few short months.
Basically, it's financial whiplash. You pull out at the bottom, then you watch helplessly as markets rocket back up without you. Bye-bye.
Yes, markets have historically rewarded patience, not panic. Missing just a few of the market's best recovery days can dramatically reduce your overall return. Timing the market perfectly, even once, is almost impossible, let alone doing it consistently. Did anyone know that March 9 of 2009 was going to be the bottom during the financial crisis? Doubtful that anyone saw that as being the day. Now let's dig into this even deeper. When you cash out, you face two big risks. The first is inflation, right now hovering closer to 3% than 2%. That means every year cash is sitting idle, it's losing purchasing power. Money sitting in cash, earning little to no interest isn't just safe, it's slowly eroding your future purchasing ability. Arguably not very safe long term. The second risk is opportunity cost. Over the long term, stocks have historically returned around 8 to 10% annually. Of course, there's no guarantee of what those returns will continue to look like.
All investing involves risk, right? Including the possible loss of principal. There's no assurance that any investment strategy will be successful. Even a diversified portfolio doesn't assure a profit or protect against loss in a declining market.
Just quick to jump all over that disclosure. By cashing out, you may preserve some emotional peace today, but you're also potentially leaving tens of thousands, maybe even hundreds of thousands of dollars of growth on the table over your retirement horizon.
So you're paying a steep fee in lost opportunity just to sleep a little easier tonight? I don't know, man. Feels like an expensive pillow.
Precisely. And might feel like trading a better night's sleep tonight for a long string of restless nights in the future. There's nothing inherently wrong with holding some cash, especially for short-term needs, but cashing out your entire portfolio or significant portions during market turbulence can dramatically impact your long-term financial security. Now, here's the better way. A well-thought-out retirement plan is like an anchor. It keeps your boat steady even when the waves are high. A good plan factors in volatility from the start. It helps you diversify your investments so that when stocks struggle, bonds or other stable investments can soften the blow. It also includes what we call guardrails, meaning you have clear rules on when and how to rebalance your investments. Having these guidelines already decided can stop you from making emotional decisions at the worst possible moment.
I guess you could think of it as setting up bumpers at a bowling alley. They won't guarantee a strike, but at least you won't roll a gutter ball.
Solid analogy. With a thoughtful plan, you're prepared in advance, meaning volatility becomes manageable rather than overwhelming. All right, let's take some action on this. First and foremost, check your emotions. Before doing anything drastic, remember that historically, staying invested has beaten cashing out. Volatility passes, but emotional decisions can cause lasting long-term damage. Second, take the time to review your plan. Do you have one? If you don't, or if it's outdated, it's time to sit down with an advisor. Your plan should clearly outline how you'll navigate volatility, including how much risk is appropriate and how you'll rebalance during market downturns. And third, maintain diversification. Make sure your portfolio isn't overly concentrated. Diversification can dramatically soften the blow of market drops. So, should you cash out and wait for calmer seas? History says no. Instead, have a solid plan in place and stick to it, even when things feel rocky. Remember, it's not about having the smartest financial advisor, the most money saved, or the highest probability of retirement success. The perfect retirement plan for you is the one you act on. Thanks for spending your time with me today. Until next time, stay steady and stay confident. You've got this.
It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Tidepool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity. Whew.